It's time to put your money to work. So, how are you planning to invest that money? After all, before you start buying assets like stocks and bonds, you should have a well diversified portfolio strategy in place. Stocks and bonds are two of the most widely traded asset classes, accessible for purchase on a range of platforms and through a variety of marketplaces and brokers. And there are some key distinctions between stocks and bonds. Welcome to Gray Skies Media. We're here to help you invest in your future. Please, do us a favor and hit that like and subscribe buttons for more content like this. Let's start with the stock market. A stock market is a platform where investors can exchange equity assets such as common stocks, as well as derivatives such as options and futures. Stock exchanges are where stocks are traded. Purchasing equity securities, sometimes known as stocks, entails acquiring a relatively modest ownership position in a corporation. While bondholders lend money with interest, equity investors buy minor holdings in corporations with the expectation that the company will perform well and the value of the shares purchased would rise. The stock market's primary purpose is to bring buyers and sellers together in a fair, regulated, and controlled environment where they can conduct business. This gives investors the assurance that trading is conducted in a transparent manner with fair and honest pricing. This rule benefits not only investors, but also the companies whose stock is traded. When the stock market is strong and healthy, the economy thrives. The stock market, like the bond market, is divided into two parts. Initial public offers, or IPOs, will be offered on the primary market, which is designated for first-run shares. Underwriters, who determine the initial price for securities, help to facilitate this market. After that, equities are listed on the secondary market, which is where the majority of trading takes place. In the United States, the prominent stock exchanges include the New York Stock Exchange is the world's largest exchange based on the total market cap of its listed securities. Most of the oldest and largest publicly traded companies are listed on the New York Stock Exchange. 30 of the biggest companies on the New York Stock Exchange comprise the Dow Jones Industrial Average, which is one of the oldest indexes in the world. The Nasdaq is the global electronic exchange that lists the stocks and bonds of smaller companies from all over the world. Most of the index is made up of technology and financial stocks, but it also has consumer goods and services, healthcare, and utilities. The benchmark index for the US technology sector is also based on this exchange. The American Stock Exchange was acquired in 2008 by NYSE Euronext and is now known as the New York Stock Exchange American. It was first known for trading and introducing new products and asset classes. The exchange was also the first to introduce the first exchange-traded fund, known as ETF. Operating electronically, the exchange is home to mostly small-cap stocks. Next, let's discuss the bond market. Investors buy and sell debt securities, such as bonds, that are issued by corporations or governments on the bond market. People also call the bond market the debt or credit market. All of the securities that are sold on the bond market are different kinds of debt. By buying a bond, credit, or debt security, you're lending money for a set amount of time and charging interest, just like a bank does to its debtors. The bond market gives investors a steady, but small way to make money every month. In some cases, like when the government gives out treasury bonds, investors get interest payments every 6 months. Bonds are held by many investors as a way to save for retirement, their children's college education, or other long-term needs. Unlike the stock market, the bond market doesn't have a central place to trade. This means that most bonds are sold over the counter. Because of this, most individual investors don't take part in the bond market. Institutional investors, like pension funds, endowments, foundations, as well as investment banks, hedge funds, and asset management firms are among those who do. If an individual investor wants to buy bonds, they can do so through a bond fund that is run by an asset manager. Individual investors now have direct access to corporate bond issues, treasuries, municipal bonds, and CDs through many brokerages. On the primary market, investors can buy and sell new securities. And on the second market, investors can buy and sell securities that they already own. There are bonds, bills, and notes among these fixed income securities. By putting these securities on the bond market, issuers can get the money they need for projects or other costs. The three main groups involved in the bond market include issuers. These are the organizations like companies or different levels of government that create, register, and sell instruments on the bond market. For example, the US Treasury sells treasury bonds, which are long-term investments that pay investors interest twice a year for 10 years and then mature. People say that investing in the US Treasury securities and other parts of the bond market is less risky than investing in the stock market, which is more volatile. Underwriters. Risks in the financial world are usually looked at by underwriters. On the bond market, an underwriter buys securities from the issuers and then sells them for a profit. Participants. These groups buy and sell bonds and other securities that are related. By buying bonds, a person lends money to the government for the life of the bond and gets interest in return. When the bond comes due, the face value is paid back to the person who bought it. Bond rating agencies like Standard & Poor's and Moody's usually give bonds an investment grade. This rating, which is given as a letter grade, tells investors how likely it is that a bond will not be paid back. A bond with a rating of AAA or AA is of high quality. A bond with a rating of A or BBB is of medium risk. High-risk bonds are those with a rating of BB or lower. One big difference between the bond market and stock market is that the stock market has places where people can buy and sell stocks. The other big difference between the stock market and bond market is the level of risk that comes with each. When it comes to stocks, investors may be exposed to risks like country or geopolitical risk, currency risk, liquidity risk, or even interest rate risk, which can affect a company's debt, cash on hand, and bottom line. Bonds, on the other hand, are more vulnerable to risks like inflation and interest rate fluctuations. Bond prices tend to fall when interest rate rises. If interest rates are high and you need to sell your bond before it matures, you can earn less than you paid for it. If you purchase a bond from a company that isn't financially stable, you expose yourself to credit risk. In this instance, the bond issuer is unable to make the interest payments, leaving it vulnerable to default. Indexes such as the S&P 500 and Dow Jones Industrial Average can provide a comprehensive picture of stock market performance. Bond indices, such as the Barclays Capital Aggregate Bond Index, can also assist investors in tracking the performance of bond portfolios. What do you think about the video? Please, let us know in the comments, and don't forget to like and subscribe. Click on that bell icon so you never miss an upload. See you in the next one.